Hey everyone! Following the recent crash in Wanwan China's share price, and after someone asked me for an update on the company, today we are going to look at the 2026 results and the latest figures published by the company to understand what's going on. If we start with revenue, Wanwan generated around RMB 24.4 billion in 2026, an increase of 3.8% compared with the previous year. Growth is still relatively limited, but it is actually above the historical trend we saw in my previous video, when revenue increased by around 2.2% per year between 2017 and 2025. So from that perspective, 2026 was a relatively positive year. The picture is less positive when we look at profitability. Gross margin declined from 47.6% in 2025 to 46.3% in 2026, mainly because of higher raw material costs. The unit cost of imported whole milk powder increased by a mid-teens percentage, while palm oil increased by a low-teens percentage. This was particularly visible in dairy products and beverages, where gross margin fell from 49.7% to 47.1%. On the other hand, sugar, gelatin, and raw paper become cheaper during the year, which partly offset these increases. The deterioration is much more significant at the EBITDA level. EBITDA margin fell from 28.7% to only 24.1%, which is the lowest level we have seen over the last 10 years. Raw materials explain part of this decline, but operating expenses were also a major factor. They increased by 14.2% compared with only 3.8% revenue growth, with higher advertising and promotion expenses, transportation costs and administrative expenses, as Wanwan invested in new products, new channels, and the creation of new product-focused business units. This is directly reflected in earnings per share, which declined from 36.7 RMB cents in 2025 to around 32.5 cents in 2026. It is obviously a significant decline compared with last year, but if we look at the last 5 years, EPS is still around the usual level for Wanwan. So based only on these full year numbers, the deterioration is quite clear, but nothing looks catastrophic at first sight. The financial structure remains one of the strongest parts of the company. Gross debt declined from around RMB 4.2 billion to RMB 2.7 billion, while cash increased significantly, leaving Wanwan with an even larger net cash position than last year. From a balance sheet perspective, the company remains extremely solid, and there is really nothing concerning here. One more surprising development is the increase in capex. Cash capex increased from around RMB 630 million in 2025 to just over RMB 1 billion in 2026, with capex intensity rising from 2.7% to 4.1% of revenue. This is almost twice the level we had seen during most of the previous years. Part of this spending went towards the new production base in Kaohsiung, Taiwan, while the group also invested in production equipment and upgrades at existing factories in mainland China. What is interesting is that despite this increase in capex, free cash flow per share remained almost unchanged at around RMB 0.30. The main explanation is that lower taxes and lower interest payments during the year helped increase operating cash flow, which largely offset the additional capex. So despite spending significantly more on investments, free cash flow was finally almost flat compared with 2025. If we now look at the dividend, management's decision is quite surprising at first sight. Margins deteriorated in 2026, but revenue was still growing and earnings remained relatively close to the levels over the previous 5 years. Despite that, the payout ratio was reduced from 40% to only 30%, which is the lowest level on this chart over the last 10 years. The latest publication from the company makes it much easier to understand why management was already so cautious. On July 26, Wanwan published a profit warning covering the 3 months ended June 30, 2026. Revenue is expected to decline by around 6% compared with the previous year, while profit attributable to shareholders is expected to fall by approximately 38%. Traditional wholesale channels were particularly weak, with revenue declining by double digits, even though they still represent more than half of total group sales. The main issue seems to come from the economics of a traditional distribution network. Consumer demand has been weaker, products have been moving more slowly at the retail level, and some distributors have accumulated too much inventory. At the same time, stronger competition from e-commerce and discount snack chains has created much more pressure on prices. This has reduced distributor margins, and in some cases, distributors have had to discount products simply to clear inventory. This eventually feeds back into Wanwan itself. If distributors already have too much inventory or are making less money selling the products, they naturally become more cautious when placing new orders. This helps explain the sharp decline in the traditional wholesale channel during the quarter. The impact on profit was even stronger because costs continued to increase. Operating expenses were still up by a high single-digit percentage, mainly because of higher advertising, promotion, and employee expenses linked to new products and new distribution channels. So revenue was already falling, while Wanwan was still spending heavily to adapt the business. Estimating a PE ratio is quite difficult at the moment because profit was down 38% in the last quarter. I don't expect this level of decline to continue over the full year, even if the company clearly seems to be facing more structural difficulties, which we will discuss later. For a more conservative estimate, I would assume EPS of around RMB 0.27, which will represent a decline of roughly 17% compared with 2026 and bring earnings back close to the level we had almost 10 years ago. At the current share price of around HKD 3.30, this will give us a P ratio of approximately 10.6 times earnings. One of the main problems today is that Wanwan has relied on the same successful products for a very long time. The brand is still extremely well known in China, and there is clearly a lot of nostalgia around products like Wanzai milk or its rice crackers. But many of these products have changed very little over the last 30 years, while the market around them has changed considerably. Management itself now admits that the company relied too heavily on a few blockbuster products and didn't innovate enough. Competition has also become much stronger. In dairy products and beverages, Wanwan competes with companies like Illy, which I covered in a previous video, but also Mengniu and Bright Dairy. Snacks and candies are even more fragmented, with a huge number of Chinese brands. Rice crackers are probably the category where Wanwan still has its strongest position, but they only represent around a quarter of total revenue. The other structural weakness is distribution. Wanwan still relies heavily on traditional wholesalers at a time when more Chinese consumers are buying through e-commerce and discount snack chains. The latest profit warning shows quite clearly how vulnerable this model can become when consumption weakens. So the difficult economic environment has made all of these problems much more visible. In a stronger consumer market, they might have been easier to absorb. But difficult periods are also when you see which companies have the strongest business models. And Wanwan is currently being forced to adapt. The positive point is that management now seems to understand the situation. The company is investing more in new products and new channels, reorganizing the business, and it is also reportedly preparing significant job cuts to reduce structural costs. Of course, the fact that such a large restructuring is needed is not particularly reassuring. These problems probably should have been addressed earlier. But at least management now seems willing to make significant changes and try to bring the company back into competition. To conclude, Wanwan actually ticks several boxes that I usually like when looking at an investment. The valuation is reasonable, and based on the more conservative EPS estimate we used earlier, the stock trades at around 10 to 11 times earnings. It is also a food business, which is generally a sector I like, and the current problems are exactly the kind of situation where investors lose interest and the valuation can become attractive. But there are still two things that prevent me from investing at the current price. The first is competition. Wanwan operates in a very competitive market, particularly in beverages and snacks, and I'm not convinced that its brand have enough pricing power to completely escape that pressure. The second is the cost environment. In my current macro scenario, I'm particularly cautious about businesses that could face higher input costs without being able to pass them fully on to consumers. Agricultural commodities have already become more volatile, while higher energy, diesel, transportation, and fertilizer costs could put additional pressure on food producers. More broadly, high government deficit and debt levels in Western countries also make me expect a more inflationary environment over the coming years. In this kind of environment, I would rather invest further upstream, directly in companies producing agricultural commodities, or in a food company with a much stronger competitive position and more pricing power. Wawa still has a very strong brand and an excellent balance sheet, but today I don't think its competitive position is strong enough to fully offset these risks. So despite the much lower valuation, I'm not planning to invest at the current price. Thanks for watching this update until the end. If you found it useful, feel free to like, subscribe and share.